Today, the big numbers are in. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, we saw a raft of fresh data. The RBA's cash rate decision and the latest mortgage stress results for April. First, the RBA left the cash rate on hold again, even though nearly half of the polled economists were expecting a rate cut. Now, we had expected them to stick, and they reinforced the labour market is the key to future rate moves, looking past lower inflation. That's a pretty good signal about what would lead to a cut. And they're still reciting strong growth that many believe is feasible. Frankly, cutting now would be using up the limited ammo they have for no good reason, and savers will definitely be relieved. Their statement included the following. The board judged that it was appropriate to hold the stance of policy unchanged at this meeting. In doing so, it recognised that there was still spare capacity in the economy and that a further improvement in the labour market was likely to be needed for inflation to be consistent with the target. Given this assessment, the board will be paying close attention to developments in the labour market at its upcoming meetings. So the message is, watch the labour market numbers. Next, the ABS released the retail figures for March. Monthly sales posted a 0.3% gain, beating expectations of a 0.2% rise, with February's surprisingly firm 0.8% gain marked up to 0.9%. So this was a slightly better than expected monthly gain, but that's where the good news ended, because the March quarter sales volumes showed all of the gains in nominal sales are due to higher prices, with sales volumes actually declining. The 0.1% contraction in real retail sales in the first quarter was actually against consensus expectations, which had been expecting a 0.3% gain, and is comparable to the flat result in the fourth quarter last year. The subcategory details highlights food prices as a key driver of the price gains. Food prices were up 1.4% in the quarter, which was a stronger increase than in the fourth quarter of last year. That said, non-food retail prices rose just 0.2% in the quarter, but food and cafes and restaurants accounted for all of the gains in nominal sales in the March month. But the real issue is the clampdown in big-ticket discretionary spending, which is more evidence of the wealth effect drag from the weaker housing market. In particular, household goods retail volumes declined 0.6% in the quarter to be flat over the year, and that's a marked slowdown on the 5.4% yearly growth seen this time just last year. Department stores also recorded a contraction, with sales volumes down 1.2% in the quarter and down 0.7% over the year. Other non-food categories, mostly small-ticket discretionary items, recorded small gains for the quarter and over the year. Cafes and restaurants were the only bright spot, recording a 1% increase in the quarter and 1.4% up over the year. Now, this data flags downside risks to the March quarter GDP, with the headwinds apparent in the second half of last year clearly carrying on into 2019. But there was better news from the trade figures for March, with the trade surplus at a massive $4.9 billion and only down a little from a record high of $5.1 billion in February, which was, by the way, revised up from $4.9 billion. For the March quarter, the ABS said that the trade surplus widened to $14.2 billion from $8.6 billion in the fourth quarter last year, and that's an improvement of $5.6 billion. But below the surface in the month of March, The import bill declined by $0.5 billion, down 1.5% to $34.4 billion, thanks to a slowing transport sector. And exports were pretty volatile. Metal ores slumped by $1.2 billion as iron ore shipments were delayed by Cyclone Veronica. But coal exports rose by $0.8 billion on a rebound in volumes, while gold fell back by $0.6 billion off a very high base. But back to the quarter data. The trade surplus grew thanks to higher commodity prices, which boosted export earnings. The terms of trade increased around 3% in the quarter. Export earnings in the first quarter rose by just over 3.5%, while the import bill shrank down by 1.4%. But this shrinkage is a sign of a weaker domestic economy as demand eases. But the net effect will be a small lift in the GDP, and the trajectory of the dollar will be important ahead. So now to our mortgage stress data. We released the April 2019 mortgage stress and default analysis update. Once again, it's the continuing story of pressure on households as ongoing wages growth is not offsetting costs of living and mortgage repayments and total debt continues to rise. Recent bank reporting highlights the elevated risks in the household sector as all of this plays out. And another 5,000 households joined the stressed ranks in the month, and Victoria was hit significantly. The latest RBA data on household debt to income to December rose to 189.6 and remains highly elevated. Plus, the housing debt ratio continues to climb to a new record of 140.2, according to the RBA. And this shows that household debt to income is still increasing. And this is confirmed by the latest financial aggregates to the end of March, recently released by the RBA, with owner-occupied lending still growing significantly faster than inflation at 5.7%. This high debt level, in the context of broader financial pressure, helps to explain the fact that mortgage stress continues to rise. And across Australia, more than 1,050,000 households are now estimated to be in mortgage stress. And that's another new record. This equates to more than 31.7% of owner-occupied borrowing households. And in addition, more than 30,400, compared with 27,000 last month, are in severe stress. And we estimate that more than 70,000, compared with 66,000 last month, risk 30-day default in the next 12 months. This is as the impact of flat wages growth, rising living costs, and higher real mortgage rates hits home. And bank losses are likely to rise a little ahead. Now, our analysis, of course, uses the DFA core market model, which combines information from our 52,000 household surveys, public data from the RBA, the ABS and APRA, and private data from lenders and aggregators. The data is current to the end of April 2019. And we analyse household cash flows based on real incomes, outgoings, and mortgage repayments, rather than using an arbitrary 30% of income. Households are defined as stressed when net income or cash flow does not cover the ongoing costs. They may or may not have access to other available assets, and some have paid ahead. But households in mild stress have little leeway in their cash flows, whereas those in severe stress are unable to meet repayments from current income. In both cases, households manage this deficit by cutting back on spending, putting more on credit cards, and seeking to refinance, restructure, or sell their homes. Those in severe stress are more likely to seek hardship assistance and are often forced to sell. Despite reassurances that household finances are fine, the pressures are rising thanks to an accumulation of larger mortgages compared to income, while costs are rising and incomes remain static. Housing credit growth is still running significantly faster than incomes, and inflation and continued rises in living costs, notably childcare, healthcare costs, school fees, and electricity prices, are causing significant pain. Many households are depleting their savings to support their finances or are trying to refinance. The probability of default extends our mortgage stress analysis by overlaying economic indicators such as employment, future wages growth, and CPI changes. Our core market model also examines the potential of portfolio loss in basis points and value terms for the banks. And losses are likely to be higher among more affluent households, contrary to the popular belief that affluent households are well protected. This is shown in our segment analysis. And regional analysis shows that New South Wales has 284,000 households in stress, compared with 286,000 last month. Victoria has 292,000 households in stress, compared with 283,000 last month. Queensland has 184,000 in stress, compared with 185,000 last month, and Western Australia has 140,000 in stress, compared with 141,000 last month. The probability of default over the next 12 months rose, with around 13,000 compared with 12,600 last month in Western Australia, around 13,000 compared with 12,000 last month in Queensland, 17,000 compared with 16,000 last time in Victoria, and 18,000 compared with 17,000 last month in New South Wales. The largest financial losses relating to bank write-offs reside in New South Wales at $1.1 billion from owner-occupied borrowers, and Victoria at $1.46 billion from owner-occupied borrowers, although losses are likely to be highest in Western Australia at 3.1 basis points, which equates to just over $1 billion from owner-occupied borrowers. Now we can look in detail at the individual postcodes with the highest count of households in mortgage stress. And this month, postcode 2170, around Chipping Norton, has 8,490 households in mortgage stress. And that includes areas around Liverpool, Warwick Farm, Moorebank, and Casula. Another New South Wales postcode, 2560, also is in the top three at 7,444. And this includes areas around Campbelltown, Rosemeadow, Roos Hill, and Woodbine. Third on the list is Western Australian postcode 6065, which includes areas around Tapping, Wangara, and Wanneroo, and there 7,375 households are in mortgage stress at the moment. Over in Queensland, in 4350, we find 6,591 households in stress, and those are areas around Toowoomba, Darling Heights, Mount Lofty, and Newton. And then we go to Victoria, to 3805, to the area around Fountain Gate and Narre Warren, where 5,900 households are in mortgage stress at the moment. Another Melbourne postcode, 3806, around Berwick and Hockaway, has 5,807 households in mortgage stress. And next, another Victorian postcode, 3810, the areas around Pakenham and Upper Pakenham, also record high levels of stress at 5,731. And then we go across again to Western Australia, to postcode 6030, to cover the areas around Tamara Park, Clarkson and Quinns Rock. And there, 5,693 households are in mortgage stress. And then we come back to Victoria, to postcode 3030, to Derrimut, Point Cook and Werribee, and there 5,327 households are in mortgage stress. And finally, another Victorian postcode, 3350, which includes areas around Ballarat, recorded 5,325 households in stress. Now, a lot of these households are living in new estates, recently constructed, recently purchased, with big mortgages, and not necessarily on the lowest incomes. But they're leveraged to the max, and they're seeing their incomes under pressure, and the capital value of their properties falling quite fast. In fact, in many of these postcodes on the list, we are seeing average declines from peak of well above 20% now. And that means that negative equity is also haunting the halls. We'll update our mortgage stress modelling again next month. Households who are in financial difficulty should not ignore the signs, though many do, and trying to refinance to resolve the problem often ends up just postponing the inevitable. We think there are, though, some simple steps that households can take. Step 1 is to draw up a budget so you can see where the money is coming and going. Our research says only half of households have any budget. This means you can then make decisions about what is most important and what can be foregone. Select and prioritise. Step 2 is to talk to your lender, as they have a legal obligation to assist in cases of hardship. Yet many households avoid having that conversation, hoping the problem will cure itself. I have to say, in the current low-income growth, high-cost environment, that is unlikely. And remember, rates are likely to rise at some point down the track. Step 3, work out what would happen if mortgage rates rose by, say, 0.5% or 1%. Pass that across your budget and examine the impact. Then you will really know where you stand and then plan accordingly. So, standing back, the big numbers today highlight considerable risks in the local economy. And whilst the backcloth of higher exports, particularly from the resource sector, is helping the GDP number, I'm afraid that the domestic economy continues to look pretty fragile. And a lot of that fragility is centred on the housing sector, which is why we are seeing retail spending continuing to ease back, and specifically big ticket items now off the agenda. Or, as Ross Greenwood on Channel 9 put it, with my help,
Shorten cannot bank on history that when the Reserve Bank changes interest rates in an election campaign, the Prime Minister also changes.
And I completely respect the Reserve Bank Governor and their independence to make those decisions.
In other words, phew. Today the RBA board did not cut. It withstood predictions from money markets and the majority of economists.
I think there's no doubt it was a big decision, but when you look at the figuring behind their forecasts, it wasn't that big a decision.
The RBA was not swayed for now by zero inflation in the last quarter year and the lack of wages growth. In his statement, Governor Philip Lowe said a further improvement in the labour market was likely to be needed for inflation to be consistent with the target. But that could change.
We think that the case will be very strong over the next 3 months.
Plenty were riding a rate cut, like Daniel and Darrell Gordon from Eldersley near Camden, who, with 3 kids, were hoping to take pressure off their mortgage.
It is bigger than I would like it to be. I would definitely like to bring that down, and an interest rate cut would help do that.
There is still one way to get a cheaper loan: change lenders.
You can get rates as low as 3.44% at the moment, but we expect this to drop down.
But for savers, rates are already close to zero.
But if you're living off the rate that you're earning from your deposits, these rates are getting very low.
A hint to the rising pressure on households is today's retail numbers. They were weak, up just 0.3% in March. Spending on food increased, but that was supermarkets passing on higher prices. In other words, more costs for families. And those pressures, says housing expert Martin North, mean more than 1 million households are now in mortgage stress.
They're raiding their savings, they're putting more on credit cards, and they're really just struggling with those household balance sheets.
Ross Greenwood, 9 News.
And it's worth saying, by the way, that even if the Reserve Bank had cut the cash rate today, I don't think that would have had any major impact on how households are feeling about their finances. And in fact, it could have scared the horses. So, in a way, doing nothing was probably the least worst option today. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.